Hi, welcome back to Real Conversations. I'm Daryl Jones, the Director of Research at Hedgeye, and we're thrilled to be joined today by Jay Pelosky. Jay's principal of J2Z Advisory. It's a New York City-based global investment advisory boutique that he founded in 2011. Jay has over 30 years of financial experience in 50 countries, spent the core of his career at Morgan Stanley, where he was a strategist, created Morgan Stanley's global asset allocation and global equity strategy products. He also formed and co-chaired the research department's asset allocation committee and launched the firm's global emerging markets, GEMS, and Latin America research products. You recently wrote a piece that I think was titled "The Big Fear."
Yes,
and
got a lot of attention. On that one.
I think a lot of people have fears right now.
Yeah.
In your view, what is the big fear or the big fears? What should people be focused on or worried about?
Well, it's a great question, and thank you for having read it. I appreciate that.
Exactly.
We always like people who read the work, right? You do the same thing. You're out there working hard, and you wonder, does anybody even care?
Exactly.
It's nice to know that somebody cares. So thank you for that. You made my day.
Absolutely.
So I guess I would start, Daryl, by saying that the last couple of months we've been basically have been ugly, right? Yep. Q3 for financial assets was the worst quarter in 4 years.
Yep.
And I think we did a lot of work discounting three big challenges, as I see it. Two were made in China, and one was made here in the United States. The two in China were first a growth scare, and then second a governance scare. And then the third one in the United States was the uncertainty around the Fed.
Right.
All right. So my view is that all the choppiness and volatility, downward directed volatility in price for most financial assets over the course of the summer was trying to discount these types of things. And I had actually written a piece called "The Global Battle Between Reflation and Recession" in July, where I argued that the odds of a recession globally were picking up significantly, and clients and investors should really stress test their portfolio for recession risk.
Why do you think the Fed is such an issue? Because if you think about it, it's sort of the Fed either doesn't do anything or they raise marginally. But you're right; it has been a catalyst for the markets. But it's we're sort of talking about a monetary policy movement that's marginal at best. And so is it just that people start, I guess, discounting the future sooner than the markets maybe are?
Well, I think that's a great question because, as I see it, there've been 2 days in the last month or so where it's really been important to pay attention to the markets. Yep. I like to sometimes say that we should let the markets tell us rather than we try to tell the markets.
Right.
And in that way, I think you stay sane, you probably avoid some big losses, and maybe occasionally you make some money. And there have been 2 days in the last month where I think this has really been very visible. The first was the day where the Fed decided to not raise rates. And when they stayed on hold and the stocks ended down, I thought that was a really telling signal. And to me, it was one of two things. Either we had a fairly significant run-up, as you recall, right, into the meeting in risk assets. Things, were up maybe 6 or 7% off their late August low. And so part of it maybe was it a buy the rumor, sell the news kind of thing? Yeah. Because I think it had seeped into people's minds as the meeting approached that the Fed was unlikely to raise rates. Or, and this is a big or, was it the beginning of the big fear?
Right.
And what's the big fear? The big fear, as I see it, is that investors will lose faith in the policymakers' ability to influence the economy. And if they lose faith, we all know, as I said in my piece, we all know what we do when we lose faith. We leave, we sell,
right.
We do things like that. You either leave or you sell.
Yeah.
You don't buy.
Get divorced.
Yeah, exactly. You don't buy, it's not good. And so I think this big fear has been lurking under financial markets for years, because let's face it, we have been underpinned by this central bank action, right? Yeah. We go back to the buffering of the fallout from the great financial crisis. And so when I saw that the stocks sold off and the Fed was on hold, that was really worrisome to me. That was my fear going into that meeting.
So the view from investors is effectively the Fed can't do anything anymore. If things get bad, They really
exactly.
have
The Fed is out of bullets.
They have no policy tools that will be effective. Yeah.
And look, there's another.
I guess 0% interest rates would be an option potentially, but
or even negative. I mean,
negative. I meant to say negative.
I have been looking at the UK as kind of the canary in the coal mine for macroeconomic policy. They've been really the leaders, and we have tended to follow them in terms of policy. And their discussion is QE for the people, right? Public financing of infrastructure, which I think would be really good use of financing of money here, or negative interest rates. And I think we are probably coming close, to that here in the U.S. But for investors, if the big fear is realized and people say, you know what, the Fed is out of bullets. And by the way, the other thing about this whole issue of the Fed and policy is that we have the fiscal policy tool, right?
Yeah.
Remember, we have two tools. We have monetary policy and fiscal policy. And as I like to say, and I wrote in my piece, the only thing we need to know about the U.S. Presidential election is that it's happening.
Right.
Because it doesn't matter who the candidate is, who wins. The reality for investors, I believe, the reality and the important thing is that for the next 2 years, fiscal policy is off the table. So we have a monetary policy that's on hold that looks like it's maybe out of bullets.
Out of bullets, yeah.
And we have a fiscal policy that, because of the electoral cycle, is locked away until late 2017.
So the big fear is that the government can't bail us out. Yeah,
exactly.
Right.
So then, exactly.
Yeah.
So then you go to the next set of questions, right? Yeah. And there are two, and they are quite easy. At what level of the S&P does the Fed get spooked into providing QE for,
yep.
right? And the second is, at what level of the S&P are things really cheap? Exactly. And my argument is that both of those answers are well below where we are today,
yeah.
right? They are not.
How far below?
Well, it's interesting because I've been asked to try and flesh that out.
Obviously that's a crystal ball type question.
It's a crystal ball question, but I think by suggesting to clients and to investors that it's much lower than here, you give people a directional sense and they can work it out themselves. I have done some work on it. What's interesting is that technical analysis and valuation analysis would suggest that it's somewhere around 16 to 1700 on the S&P. If you think technically, and I'm not a technician, but I'm a believer in looking at all sorts of factors, right?
Yep.
And technical analysis is one of them, particularly in markets like this. And so if you break the 1870, which was the low in late August, and retest the late October 14 low, so almost a year ago, which is around 1820, 1830, the next stop, people suggest, is somewhere around 1600.
Is that level? Yep.
Yeah. Now, valuation-wise, if you, and here's an example of why we have, I think, a challenge in front of us, is the 2016 consensus is for 17% earnings growth right now.
Yeah.
That's not even, that's like so pie in the sky as to be crazy.
Actually, it's a good question. We've been of the view that growth is going to be a lot slower than people expect for a while. That's obviously now playing out. Why do you think, and you were at Morgan Stanley, we're both kind of on the sell side, but I think we're contrarians as it relates to the sell side. Why do you think these numbers are, and what in general, why is the sell side just so off in times, especially in times of inflection? Do they just...
Well, people are slow to change, right? And that's one of the, I mentioned in terms of J to Z, one of the things I like to emphasize and which clients find really valuable is my independence.
Yep.
And we know, if we've been part of big firms, nothing against big firms, but they are consensus building machines.
Right.
And it takes time to build consensus through the machine. And therefore, and your bottoms up has got to marry your top down, and it's like all these things. And so I think that's part of it. I think the other part of it is what the Q3 is a telling time, right? Everybody now starts to think forward into 16. Investors are going to be driving that process by demanding that the analysts and the companies give them some sort of view into 2016.
Yep.
And so I think you're going to see those numbers come in dramatically. But when I did my little exercise, I said, forget that. Forget 17% earnings growth. It's not even close to happening. And said, okay, plus or minus 4% earnings growth from 2015, and then a valuation band, 18 on the high end and 14 on the low end.
Right.
Okay? And that brings you out plus or minus 4% EPS growth, 18 times trailing would bring you to about 2080 by my calculations. So that's your upside. Not even 100 points from here, so not even 5%.
Yeah.
And then your downside, minus 4% earnings growth at 14 times earnings is 1,600, roughly, 1,625 or something. So, risk reward suggests that's not really all that appealing.